Welcome to today's Savant Live webinar. Thank you for joining us. Today we are discussing funding healthcare and retirement. My name is Brian Knabe, and joining me today is my fellow financial advisor, Maureen Wright. I'm also a medical doctor by training, so I have some unique perspective on this topic. Please note that you'll have an opportunity during the presentation to type questions for us online, and we'll try to answer as many of those as we can at the end of the presentation. As advisors, we see that planning the healthcare coverage and expenses is a prominent concern for our clients. During working years, the management of this is relatively simple, as most of us obtain healthcare coverage through our employer. Employer-provided health care benefits for retirees used to be much more common, but a recent study shows that only 4% of employers offer such benefits today. Fidelity Investments recently estimated that a 65-year-old couple retiring in 2022 will spend approximately $315,000 on healthcare expenses during the course of retirement. While this can seem intimidating, planning and following useful strategies can certainly help to bridge the gap. Today we will be covering a general overview of the healthcare landscape. We will also discuss Medicare. Many of you who have already applied and are on Medicare may be familiar with some of these items, but hopefully you will learn something new about the topic as well. We will then discuss some strategies that can be useful in planning for these expenses ahead of time. With that, I will turn things over to Maureen to start us off.
Brian, thank you, and hello everyone. Thank you for joining us this afternoon. Brian and I are very excited to spend the next hour with you going through the healthcare landscape and coming up with some tax-efficient ways to plan for these expenses. So one of the reasons Brian and I were excited to present on this topic today is because healthcare is often a very overlooked and underestimated part of someone's financial retirement plan. What we find is when folks come to us to have conversations about projecting out their retirement, whether it's a few years out from retirement or early into the retirement years, it's very easy for them to communicate with us their plans for fixed expenses, discretionary spending, helping us identify what type of travel they want to do, family gifting. But one huge financial goal that is often overlooked is healthcare expenses. As Brian already alluded to, that can be a rather sizable expense, $315,000 according to Fidelity's most recent survey. So we want to spend the first part of this presentation just kind of circling back as to why it's so important to plan for healthcare and have plans in place to support those really large expenses during that period of time. So let's look at some of the contributing factors to why healthcare can be such a cost for folks in retirement. The first being longevity. So what we have here coming from JP Morgan's Guide to Retirement is that there is a look at actuarial life expectancy for both men and women. And what we can see from this little chart here is that as time goes on, life expectancy only gets longer and longer. So today in 2020, or here we are in 2022, that someone at the age of 65 has a life expectancy, if they're a female, of 84.5 years, and men 82 years. So again, we've seen this trend of folks living longer and longer. What I think is even more alarming and a point to really focus on is if we look at the bar graph below, that there's a 72% chance that for a couple, one of those spouses living until age 90. So to put that in perspective, if we're having conversations with folks that want to retire at say 65, and at least one of them will be living until age 90, that's 25 years worth of healthcare expenses that we have to be planful of and mindful of. That longevity coupled with increased inflation, and we're not speaking to the higher inflation we're seeing today, certainly that's playing into all this, but historically, healthcare expenses inflate at a much higher rate than our typical common or traditional common goods and services. In fact, when we do plan projections for folks and we examine these healthcare expenses, we often call out and use a higher rate of inflation for those expenses, almost double what we would be using for traditional inflating expenses. So somewhere in the ballpark of 5% plus. So those two factors together is what really leads us and puts us in a position where these healthcare expenses can be as much as $315,000. Another reason we wanted to get together for you all today on this topic is that, as we know, the healthcare landscape can be very confusing. There are a lot of different terminologies and terms out there. Medicare can be a very confusing landscape as well. And so our objective with today is to help walk that path with you and provide some additional insight and clarity during today's conversation. So to go back and just touch on the anticipated expenses that come from healthcare expenses, I think this chart does a really wonderful job of showing the ebbs and flows of income needs for folks. This graph starts at age 40. So think of your peak earning years, you've got young kids. That's really when life is most expensive for folks. As they transition into retirement, we see a natural kind of trailing off of some expenses. But what you'll notice is that around age 80 or 84, we start to see an uptick. And the largest contributing factor, which may not be a surprise for you all, is healthcare. If you look at that lime green figure there, that healthcare expense just steadily rises and becomes a larger line item in folks' budgets in retirement for the reasons already discussed, things like inflation and perhaps there's a long-term care event where there's a prolonged medical event. So just, to reinforce this fact that healthcare is not something to turn a blind eye to, and it should take a priority in your financial planning and ensure that you have a contingency plan in place to support that. So one more slide before we kind of move into and start our deep dive discussions on Medicare and ways to be proactive in funding or pre-funding some of these expenses is where most of you are today. You may be joining us, you're currently working, and healthcare and health insurance really isn't taking a primary focus because it's something that you're obtaining currently from your provider. You have a nice income source that's going to help offset and cover those premium benefits as well as maybe any out-of-pocket expenses or life events that are happening. But really the dynamic shifts when you move into retirement, especially those years prior to Medicare. What we'll learn from Brian in a moment is that Medicare starts at age 65. So for folks that are looking to retire before age 65, there's this really unique period where you have to be very mindful and understand that those expenses could be quite high because you're having to, purchase an insurance product on your own, go out to the open marketplace, what have you. Our primary objective for today's conversation is to really look at, again, we'll spend some time on Medicare, but look at ways to be proactive and pre-funding and having a reserve there in place to meet these additional expenses that come with healthcare later in life and certainly in retirement. So with that, I'll pass it back to Brian and he will walk us through Medicare.
Okay, thanks, Maureen. Medicare as a program has been around since 1965. There are currently four main parts to Medicare, parts A, B, C, and D. People qualify for Medicare, as Maureen mentioned, starting at the age of 65 and potentially sooner if there's a person with a disability. We'll spend a few minutes reviewing the different parts of Medicare listed here. Medicare Part A and B are considered the original Medicare. The main thing covered by Part A is your typical hospitalization. It does also cover some limited nursing home care and some home health services, as well as hospice. Part B covers your outpatient medical care, including office visits. It also covers laboratory and x-ray testing, rehab, and both inpatient and outpatient mental health care. Most people sign up for both Part A and Part B of Medicare. Part A is provided at no expense. However, there is a premium charge for Part B. As I mentioned earlier, most people qualify for these services at the age of 65, potentially earlier if there's a disability. An important thing to note is that if a person does not sign up for Medicare Part B at the time that they qualify, the expense of that premium can go up by up to 10% each year that a person waits to sign up. And those premiums will be paid for as long as the person is on Medicare. So it certainly makes sense to sign up for this when you are eligible. An exception to this is if you are 65 years old and still working. If that is the case, you have healthcare coverage through your employer, you don't have to sign up for Medicare Part B right away, and you will not be subject to a penalty for delayed enrollment. But it's certainly good to verify that and talk to your advisor and make sure you're doing the correct thing there. Moving on to Part C, this is an optional portion of Medicare. Not everyone signs up for this. Part C is a Medicare Advantage plan. These plans are offered through private health insurance companies, basically acting as an HMO or PPO for the recipient. Unlike other portions of Medicare, hearing aids, dental coverage, and vision coverage with glasses may be covered by this type of plan as well. Each of these plans is different, and you should review the options very closely before signing up. Also important to note, the Part C plans are actually not available currently to new enrollees who signed up for Medicare after January 1st of 2020. People already signed up for Medicare can enroll in these, but they are not available to new participants. There are some potential disadvantages to these Part C plans as well. First of all, you have to make sure that the one you enroll in covers the geographic area where you are looking to receive care. There are limitations to the services and providers within the plan. And as with any HMO or PPO, prior authorizations might be needed, and these can be restrictive at times. Also, there might be other costs that are involved that might not be apparent upfront, things like extra copays and deductibles and things like that. Medicare Part D is the most recent addition to Medicare, and this was added in 2006. Part D covers prescription drugs. One unique thing about this program is that there's something called a donut hole, and that's an area where coverage is not provided. Benefits are provided up to a certain dollar amount, and then there is a gap in coverage until a certain amount has been paid out of pocket by the recipient. In 2022, the coverage temporarily stops after $4,430 in expenses have been paid for the year, and it does not restart until the participant has spent $7,050 in out-of-pocket drug costs. So in summary, these are the different portions of Medicare that can be provided. As I mentioned, most people sign up for Parts A and B. There's no cost for Part A, but there is a premium charge for Part B. Some people sign up for the Medicare Advantage programs in Part C, but this is certainly optional and not currently available to new Medicare enrollees. Part D is optional, and there is an extra cost to this plan, but it does cover prescription drugs as well. Medicare supplements can also be purchased on the open market at an additional cost. We won't get into a lot of details about those today, but Medicare supplements, also called Medigap policies and Medicare Part F or Part G, can cover and fill in Medicare gaps, including coinsurance, copays, and deductibles. One potential planning opportunity when it comes to Medicare is to try to keep income below a certain level in order to keep from paying higher Medicare Part B premiums. The base premium this year is $170.10, but as you can see, as it goes up significantly as income increases. The maximum monthly premium for a person on Medicare Part B is $578, and that's per month per person. So that does go up quickly. Sometimes the increases can be mitigated by managing your IRA withdrawals or other income during retirement. And these increases are important to consider if you're thinking about doing something like a Roth conversion. These premium increases are based upon the income from the participant's tax return that was filed 2 years previously. So for example, in 2022, they'll be looking at your 2020 tax return and the income there to determine your monthly premium. If your income has gone down significantly in the interim between that tax return and the current year, you can fill out a Medicare form and apply for an exemption to that premium increase. If that situation applies to you, you should talk to your advisor or your insurance agent about the process for completing that form. A few other considerations regarding Medicare. First of all, your Part D premiums can go up based upon income, just as they do for Part B premiums. However, these price increases are not as onerous. Medicare might cover some nursing home care, but only for a limited time period. Longer stays in the nursing home are not covered, and Maureen will talk a little bit more about that soon here. In general, with some exceptions like Medicare Part C, vision and dental are not covered. If you work with an advisor who does retirement projections and is planning for you, you should be sure that all these costs, as well as those inflation figures that Maureen mentioned, are included in your plan. As Maureen mentioned earlier, at Savant, we inflate those medical expense numbers higher than the rate of general inflation. You should make sure that that's in your plan. So with that, I'll turn things back over to Maureen.
Ryan, thank you so much for walking us through Medicare. Some really great information there. But really to continue this conversation, what we're learning is that Medicare isn't an all-inclusive solution to healthcare expenses in retirement. And that's going to be kind of our transition into the second half of this presentation. It's identifying resources and tools available to us to help pre-fund and be intentional in saving for these healthcare expenses, either not covered by Medicare or that come up unexpected. The first tool that we will be looking at is called a health savings account. You may also hear me refer to it by its acronym HSA. This is personally one of my favorite accounts to talk about. So look forward to bringing you through this section here. For some of you, this may be a refresher if you already maybe are enrolled and have an HSA. For some of you, this may be your first exposure to it, and look forward to diving in a bit deeper to the basics here of a health savings plan. So at its core, it's a tax advantage medical savings account, with really the purpose being to save for future healthcare expenses. I want to look at that word future for a moment. So that could be future as in 2 weeks from now, or it can be future as in 20 years from now. And that's something we'll dive into as we move through today's presentation. But the purpose really being is that there's this account that was created that incentivizes folks through tax incentives and tax advantages to actively contribute to build up this fund that at some point it can be used to offset some healthcare expenses. One thing to be mindful though is that there are eligibility requirements that you have to be aware of. Not everyone has access to a health savings account. You do have to be participating in a high deductible healthcare plan. So for those of you that are currently working, you may already be part of your firm's high deductible healthcare plan. For others, likely there's this option, but you may not be as a part of it. One area that we really encourage clients to look into is understand the healthcare benefits offered through your employer. And if it makes sense based on your financial and based on your health situation, it may be opportunistic for you to move into that healthcare, that high deductible healthcare plans that you have access to this HSA. And we'll get into it just a moment why this is such a wonderful tool. But the idea being this HSA can help supplement or support those higher deductibles. So it's not necessarily putting you at a disadvantage. While the deductibles may be higher, you have this account you can pull from to make up the difference. One other eligibility requirement to be mindful of is that once you do enroll in Medicare, so as Brian mentioned, that's for most people age 65, or if you continue to work and delay that decision, as soon as you go on Medicare benefits, you no longer have the ability to contribute to an HSA account. But let's talk a bit more about some of these account characteristics, because this is really where that health savings account shines and where people start to understand that the benefit of having this as part of your investment lineup for retirement. One thing that I'll kind of put out there is when talking about this with clients, I often refer to it as a healthcare IRA because it does share a lot of similar characteristics to an IRA account, a traditional IRA account. And we'll see that there is one area where it actually mirrors more of a Roth IRA, and that's an account that I know most folks get pretty excited about because of the tax-free characteristics. So let's go through some of the ways that this mirrors more or less a healthcare or acts like a healthcare IRA. The first being that there are contribution limits. So much like those that are contributing to a traditional IRA, each year we're limited in terms of how much we can put into this account. And the same rule applies for HSAs. Depending on how you're enrolled in your high deductible healthcare plan through work will determine if you can contribute as a single individual or as a family. So we have listed here for you what those 2022 limits are. Each year they do get adjusted and go up. What's important to note, and we'll circle back to this in a moment, is that if you're over the age of 50, you can have a catch-up contribution of additional $1,000. So again, if you're over 50 and you contribute as a single individual, that number would be $4,650 in tax year 2022. Moving right along, some other healthcare or some other similarities to an IRA is the way that things are taxed. So this account is one of the few accounts that has this triple tax advantage, meaning that at every step in the process, from contributions to growth and to distribution, there are tax advantages to those that participate. From a contribution perspective, there these contributions are going to be pre-tax. So the year that you make the contribution, your tax situation will be benefiting from it, and that these are made with pre-tax dollars. Again, very similar to that traditional IRA. From a growth perspective, as these accounts grow through investments, they're tax deferred growth. So again, very similar to a traditional IRA. On the distribution side, this is where the health savings account really stands out above all other options to help support healthcare expenses, in that if they're used for qualified distributions, which we'll review here in just a moment, but think medically necessary and medical expense, that's going to be a qualified distribution from an HSA, that's going to be tax-free. So you can start to see the similarities and how that aligns nicely and looks a lot like a Roth IRA, in that those distributions are tax-free. One additional characteristic that is very important to point out is that this is an account that you have the ability to continue to add to and accrue a balance. Many people are familiar with what's known as a flexible savings account or an FSA. That's an account where as you fund it, there's a requirement to use that money in a year before that money, it's more use or lose it. With an HSA, you're actually incentivized and encouraged to keep accruing a balance. So each year you can make those maximum contributions and keep that account balance growing, and it has the added benefit of being able to invest it and have that grow even more. So another way that it looks and feels a lot like an IRA, and the fact that it is an investable account. So let's go through the HSA life cycle. So looking at this account from the contribution stage all the way through distributions. As we talked about, these contributions are pre-tax. So again, you have that incentive the year that it's made to move money into that HSA. There are annual contributions that you have to be mindful of, and don't forget to take advantage of that catch-up if you're age 50 or older. As I mentioned, this is an account where you're encouraged to have that accrue over time. The reason being is that you have the ability to invest. In a recent study from Fidelity, it actually discovered that over 50% of people didn't even realize that an HSA is an account that they can invest. So for those of you on today's webinar that have an HSA, a call to action is to go and take a look and make sure that that account balance is being invested. If it isn't, I strongly encourage you to connect with a professional and figure out maybe the best investment solution for those funds themselves. We want that money to grow. You want that money to grow in the markets because it is tax deferred growth. And that's another one of those tax advantages to this account. One thing of note is most custodians often require there be a minimum amount that remains in cash. Depending on who you work with, that could be anywhere from $1,000 to $2,000. For any dollar balances above that threshold, be sure to get that money invested and have that working for you as much as it can. Now for the distributions. This is the area where often there's some confusion, and our objective today is to help kind of clarify some of these obstacles for you. So distributions, when used for a medical expense or a medical care expense, is going to be considered a qualified distribution. If qualified, that means it's a tax-free distribution. So think of that every dollar in that account is pure purchasing power when used for a qualified expense. I've thrown up on the slide here some examples of qualified expenses: prescription drugs, dental care, glasses. As Brian mentioned, Medicare Parts A, B, and D, they all carry premiums. And this is an account that we can use as a source for those premiums and get that after-tax spending power. Hopefully you're looking at this and making some connections, saying, oh, I have these expenses, or I plan to have these expenses in retirement. How great would it be to pull from a tax-advantaged account like an HSA? From the distribution side, it doesn't just apply to you as an individual. This includes being able to reimburse yourself for expenses for spouses and for dependents. Now, while the suggestion is usually to use this account for qualified expenses and really get the most tax efficient outcome for these dollars, you certainly have the ability to distribute for really anything that arises. What's important to note is that there is a distinction between contribution or distributions that are made before age 65 and after age 65. Those are going to be treated differently in terms of a penalty and tax treatment. And I have a chart here we'll look at in just a moment that really summarizes the tax ramifications based on what type of distribution you're taking from the account. So here is a chart just for you all to look at. I think the biggest distinction and thing to keep in mind as you're navigating these retirement expenses and these healthcare expenses in retirement is that if you are over the age of 65 and using the account for qualified expenses, again, that's going to be tax-free distribution. If it's non-qualified, essentially you're going to pay tax at your ordinary income. So think of that healthcare IRA. It's going to be treated much like an IRA is. Every dollar that comes out is taxable at your prevailing rate. If you're under 65, the area to really be mindful of is while you can still take money out of this account for things other than medical expenses, know that it's going to be non-qualified and you'll run into that additional 20% penalty in addition to paying at your prevailing income rate. So just something to be mindful of there. So if you are listening to this presentation, you're saying an HSA makes great sense. I'm going to go to my HR, sign up for that high deductible health insurance plan and get started tomorrow. I applaud you. Now let's kind of move into ways that you can use that HSA. As I mentioned earlier, the purpose of this account is to fund future expenses. Again, that future could be 2 weeks from now, or it could be 20 years from now. But I want to share with you 2 different approaches to how you can navigate using this HSA and have it work within the context of your financial life. The first I jokingly refer to as the beginner approach. While in all actuality, if you have an HSA already, you're far from a beginner. You're a very tax savvy investor and you've identified areas where you can really be more tax advantageous than someone just using a brokerage account. But with this beginner strategy, essentially you'd fund this account on an annual basis. You'd reimburse yourself for things like getting contacts or glasses or going to the doctor's office. Once those bills accrue, you'd reimburse yourself, get that tax-free treatment, and then repeat the process next year. Likely what would happen is your balance would more or less stay the same and likely be sitting in cash. What I encourage my clients to do and would encourage you all to do as well is if your finances allow it, if you're going to continue to, if you are to max out this account, as opposed to reimbursing yourself for expenses that are happening in the here and now, pay for those medical expenses out of your pocket and allow that balance to just really accrue and get that money invested and really working hard for you. In this approach, you're really delaying that distribution either until retirement or until there's a big medical need that arises. So I encourage folks, maybe they can't take this advanced approach every given year based on financial events, based on medical events, where you can to really kind of delay the gratification that comes with this account and be more proactive and get that money growing in that account so that it's positioned really well in retirement to meet those expenses. So what I'm going to show you here is just an example of what that could look like. This individual has taken that advanced approach where they've paid for medical expenses that have accrued out of their pocket. This individual has maxed out family contributions starting at age 50, that wrapping up at age 65, with the assumption being that they've gone on Medicare. And what you can see here is that the ending balance is quite impactful, over $240,000 worth of money sitting in this HSA account that they can apply towards future medical expenses. Certainly, you may be looking at this and saying, well, that could happen in a brokerage account or a taxable account. And absolutely, any account that's invested, you can ultimately see some tremendous returns and balances at the end of a 15-year period. But look at the tax savings that you'd be missing out on, over $36,000 just from tax deductions. And look at another $91,000 that you pick up in tax deferred earnings. Hopefully this is painting the picture for you all that this HSA is a very valuable tool and one that I encourage you to take advantage of as soon as reasonable. One thing I'll note is as you're going through this presentation, if you're thinking of things in your personal situation that you're wondering if they may or may not be tax free or a qualified distribution, there's an all-inclusive list on the IRS's website and would encourage you to take your list of things there and cross-reference that and see where they fall. Is it qualified or non-qualified? But some of the big takeaways from this health savings account is really it's a very tax efficient vehicle. It's one of the few accounts that has this triple tax advantage characteristic in that contributions, growth, and distributions are all are all tax advantage. Versatility, again, the idea being that if need be, all these dollars aren't locked up and promised to healthcare expenses. If you have a need to pull from this for other expenses, it really kind of just turns into an IRA at that point. If you're over the age of 65, you have the ability to pull from this account to meet for other retirement expenses, knowing that you'll just be paying taxes at your prevailing income tax rate. And finally, retirement. Yes, you certainly can think of this as a retirement account, but it also can be used in the here and now. So for example, this past year I gave birth to a baby girl, and it is not inexpensive to give birth to a child. And so it was nice to have an account there all ready to go to help supplement some of those larger expenses for a bigger healthcare year. So we would be remiss if we didn't talk about long-term care. For many folks, when you think of healthcare, especially healthcare in the context of retirement, your mind jumps to a long-term care event or a prolonged stay at, whether it be a nursing home or assisted living facility. This part of the presentation is really going to be looking at different tools and assets available to you to help, again, subsidize or offset some of those costs that come from a long-term care event. Brian and I, we're not licensed to sell insurance. This isn't a push to get you all to go for policies, but our intention today is to really help you understand the landscape and the different options and tools at your exposure to help offset costs if that's something that is a priority and a concern for you. To give you some context, long-term care insurance specifically really got its start in the 1980s. The 1980s. In the 1990s, it became a very popular tool. Again, people were purchasing policies with the intent to offset costs that are associated with the prolonged medical event, forcing them to move into a nursing home, assisted living, or having to bring in-home care. The underwriters that went about creating these policies were a little short-sighted. They didn't quite anticipate people living longer, or the fact that healthcare expenses would inflate at such a rapid pace, things that we've already covered and discussed in this presentation. So they found themselves in a tricky situation where they were overexposed in the sense that people were calling to take advantage of these long-term care policies and pay out these benefits at rates that they were not expecting. So really what occurred to right the ship is that premiums went up. So these now traditionally pure long-term care insurance programs are very expensive. Those premiums are really high, or in some cases, those providers just discontinued carrying those policies altogether. As we mentioned, healthcare expenses are really quite expensive. And when we look at a long-term care event, such as moving into a nursing home, some of the average costs associated with that can be as high as $8,000 per month. And an average stay, according to the American Council on Aging, it can be as long as 3 years. So imagine as those costs really start to add up, and that can have a big ripple effect and a huge impact on someone's long-term financial goals. And so these long-term care policies are really quite prevalent to help take away and subsidize those costs, more or less acting as a firewall between someone's financial portfolio and some sort of event like this. Certainly there are ways to get around the higher costs. With any long-term care or any insurance policy, you have the ability to really customize benefits to tailor and meet your needs. So whether it's a policy in one person's name versus two people's name, or a joint policy to help bring down costs, playing with features such as waiting periods and daily benefits and benefit periods, those are all ways to kind of help with managing those expenses. One thing I will mention, though, again, with long-term care, because it is so cost prohibitive, there's not a huge subset of folks that this makes great sense for, unless you are truly risk averse and you want to transfer all that risk of a potential event to an insurance policy. But again, being able to support absorb the cash flow requirements that come with that. Another point that I'll mention with long-term care is that it's a user or lose it proposition, meaning if, for example, an insured goes peacefully in the night and never has a long-term care need and never actually draws on that benefit, the insurance company essentially won in that scenario. So for those reasons, long-term care, while it had its heyday in the 1990s, is starting to kind of kind of fall into the background, and they're new policies or newer policies today that folks rely on to kind of help absorb some of these costs. And that brings us into hybrid insurance policies. These are life insurance policies that have a long-term care benefit or focus to it, whether it be a rider, whether it be a specific benefit pool that's created. But what I think is important for folks on this call today to understand is that it really takes the best of a long-term care policy as well as a life insurance policy and marries the two together. And by doing that, we create something that isn't this use it or lose it proposition. With these hybrid policies, essentially a benefit pool is created that can either go to offset long-term care expenses when a need arises, or it goes and passes on to the beneficiaries based on whether or not that benefit pool is needed, or perhaps a combination of the two. There are some folks that maybe have a long-term care need that arises, they're in that facility for a year, ultimately pass away, and there's still funds left in that benefit pool to go to that next generation. So in many cases, these hybrid insurance policies can make great sense to, again, absorb some of that risk that may come from a long-term care and a prolonged medical event. Some things to just note, and with everything we're talking about in this section here, certainly work with an insurance broker, work with a professional that knows these policies back and forth, but you certainly can customize policies like you can in most situations to have more of a long-term care focus or more of a life insurance focus based on what risk is most prevalent and most important for you to cover. One other thing that I'll mention, folks for you that are on the call that maybe have life insurance policies that you've had forever and maybe no longer have the same insurable needs, in the sense that, you know, your kids have flown the coop, you no longer are worried about the proposition of dying too soon and leaving, you know, a spouse and children without income source. Maybe now your concern is living too long or outliving your assets. Take a look at what you currently have, and there could be opportunities to do what is called a 1035 conversion, and essentially take that whole life, that variable life policy, and convert it into a hybrid policy, or add certain features into the account so that it looks and feels like this hybrid policy. That's a really effective way to repurpose assets that you already have and have them be focused for the new sets of concerns or priorities going into, you know, the second half of life, into retirement. So just some things for you to consider as it relates to a long-term care scenario. You know, there are a lot of folks out there that may say, if you have $2 million or $3 million or fill in the blank, then you can self-insure when it comes to a long-term care event. And I'm hesitant to say that or put a number there because everyone's financial situation is so different. So I would really encourage you, if this is an area of concern that you have and are curious how this may impact your family, should there be a long-term care event that arises, is to stress test your plan, whether it's connecting with your Savant advisor or another trusted professional. Go through the scenario, see what would happen to your financial plan and your family should there be a long-term event. You're in a facility for 3 years or what have you. This is also a wonderful opportunity to really take inventory of what you have from a risk management perspective and see if those policies are still best serving your family's needs. If, for example, the focus is no longer the fear of passing too soon, it's now outliving your money, it may make sense to see if there's a 1035 or some other conversion in place to align your balance sheet to match your primary concerns and needs. And as I mentioned before, you know, certainly speak with professionals, go to them to get the guidance and make sure you think everything through before really making a change to that regard. So with that, I will pass it back to Brian to kind of take us through our wrap up here.
Thank you, Maureen. Great information there. And just to kind of summarize and look at a general timeline for things to do when you're planning for healthcare expenses in retirement, there are really different phases to look at. First of all, when you're younger, a high deductible health plan with HSA coverage can have many benefits, as Maureen discussed. As you get older and into your 50s, maximizing that HSA funding can be helpful, and consider letting that balance build up for future expenses if you're able to do so. When you reach your 50s, it's an important time to start looking at other strategies such as potential long-term care insurance options. Once you are in your 60s, it's time to start looking at which Medicare options might be best for you. Continuing HSA funding is also important for as long as you're eligible to and are employed and eligible to make those contributions, or as long as you have that high deductible health plan in place. Income management becomes important, especially as it relates to Medicare Part B and Part D premiums. During retirement, of course, you can also use that pre-funded HSA balance to pay for a variety of expenses. And also, starting at the age of 50 and beyond, it's important to go through that retirement projection process and make sure that all these expenses are covered by the plan that you have in place. And it's important to work with a good financial advisor who can help you with those projections. So in summary, keep yourself educated about all the different ways that to help fund your healthcare expenses in retirement. It's important to understand your needs and how those relate to your plan. Working with your team of experts, including a financial advisor and likely independent insurance agents for Medicare supplements and potentially long-term care options is important as well. And now with that, we're going to answer some questions that have been submitted throughout today's presentation. And I see that some questions have come up, and we'll answer as many of those as we can. And you're still able to submit new questions as we're talking here as well. So feel free to do so.
All right, let me pull up and see what questions come in so far. One of the first ones I'm seeing here is about the HSA. The first question being, what is the timeline for reimbursements? So to give some context, as I mentioned, if you incur healthcare related expenses that are deemed qualified, if you pay for them out of pocket, you can ultimately go in and reimburse yourself. And one unique feature of the HSA is that there is no time limit. So in theory, you could accumulate every single receipt that you have from any medical expense and just take it all out at one point. As long as there's good record keeping, that won't be an issue.
One question or comment that came up here was some confusion about the Medicare Part C versus Plan C. I think I did misspeak about that. Medicare Part C is still available, but Plan C, which is a type of Medicare supplement, is no longer available. And again, I didn't talk a lot about the different Medicare supplements that are available, but suffice it to say, at the beginning of 2022, several changes were made. A couple of the options that were available in the past are no longer available to new retirees, but there are still some very good Medigap and Medicare supplements that are available. So it's important to talk to a good insurance agent about that. I recommend someone who really specializes in Medicare supplement policies, and they can help you to navigate that as well. So thanks for that question, and that clarification hopefully is helpful.
There are a lot of questions here about HSA funding in the year that Medicare takes place. So the first one I'll just answer is, what happens the year that you file for, or the year that you enroll for Medicare? Depending on, essentially, the answer is that it's going to be prorated. So let's say, for example, you enroll in Medicare in June, so middle of the year, you'd be able to put up to 6 months worth of contributions into the HSA. So you take that that maximum contribution amount that you're allowed to have. So let's say it's for a family, $73,000 over 12 months, whatever that prorated amount is, you'd be able to put in 6 months worth of that into the HSA. And then again, once you enroll in Medicare, that door does close. But there are opportunities to kind of squeak in some final funding before the door formally shuts on because of Medicare.
Yeah, we do have a number of questions related to that about, when can I contribute to, to these, to an HSA. And, the most important thing is that you have to be, prior to Medicare and on a high deductible health plan, and it's completely prorated as Maureen mentioned. So if you're covered for 5 months under a Medicare high deductible health plan, you get to make 5/12 of the maximum contribution, and they look at that very closely. One question here, what options do you have if your employer does not offer an HSA account? That's a very good question. It's, now, first of all, sometimes employers don't offer an HSA account because they don't have a high deductible health plan. So you really want to make sure if they do not offer an HSA, it's because, but they do have a high deductible health plan. You want to make sure that that's true. And if there's the high deductible health plan, but not the HSA, you can actually open your own HSA at various providers, various banks and investment companies might offer that, and you can make that contribution on your own. So you are able to do that. It's best now if you have an HSA with your employer, you can decline to participate that and open your own elsewhere, but you don't get the savings on FICA taxes and Medicare taxes that you would with a direct direct contribution from your payroll deduction. So if there's an HSA through your employer, usually we recommend to use that one as long as you're employed there.
I'm looking through some of the questions here to answer something different that we haven't covered. Let's see. A lot of questions on timing. When you're eligible to contribute to an HSA, and just keep in mind that your contribution to an HSA is going to be dependent on how you're enrolled in a plan. So let's say, for example, you have a spouse that's older that maybe is already on Medicare. You, as the spouse that's under Medicare age, you can still contribute to an HSA as a single individual. You could maybe qualify as a family if you have a dependent that's on that plan with you. But let's say, for example, it's just the two of you in your family unit. If one spouse is already on Medicare, but you as a single individual are not, you can contribute at that stated maximum contribution as a single filer, unless, of course, you have a child still on your plan as well, and then you'd qualify as a family. So maybe an incentive for some of you out there that have children that are, maybe they've flown the coop, but they're still eligible to be on your plan, to keep them on so you can use them for those additional HSA contributions. There's a question here about if you're able to transfer monies from an IRA into an HSA. Didn't want to go into too many details on this in today's presentation, but know that you are permitted to do a one-time rollover from an IRA account into an HSA. Again, that's just another way to really jumpstart and fuel that account. The exact amount of that one-time rollover is limited. The figure is escaping me at the particular moment, but certainly something to take to your financial advisor, and they can kind of clear up and firm up the details there and strategize when may be the best time to make that rollover contribution or that one-time rollover to really jumpstart that HSA on your behalf.
There's a question here. What are typical, what are typical insurance costs prior to being eligible for Medicare, retire at 60, for instance? Yeah, very good question. We just alluded to that a little bit, but really it depends a lot on your personal situation. First of all, if you just leave your employer, you can get COBRA, and that's coverage that you're eligible to pay for. You pay for the whole cost yourself. It's more expensive than than if you were paying through your employer and they were contributing to some of that cost. If once you're beyond the COBRA period, and if you're before Medicare, the main options would be to look for just health insurance on the open market. You can talk to an insurance agent who purchases that or who sells that and can help you with that. Going to the healthcare.gov, the Obamacare as it's been called, can be a good option as well. That's a little bit more expensive option quite often. But if you're able to manage your income, many clients are able to qualify for a subsidy for that as well. But just as a general rule, when we do projections for clients, we look at that time period, retired pre-Medicare and retired on Medicare. Usually the expenses pre-Medicare are actually just a little bit higher than they are during Medicare. They often get under better control when you're on Medicare, especially if you have Part A, Part D, and Part A and B and Part D in the Medicare supplement or Medigap policy. It's usually pretty reasonable. Prior to that, we usually estimate maybe 50% higher costs. Maybe for a couple might be $20,000 a year, for example. But again, it depends on your personal situation. Good to talk to your advisor about that.
There's a question in here about the 1035 conversion process that I outlined during the long-term care section of this presentation. Who do you talk to? Certainly, I would go back to your agent, whoever originally sold you your policy, have a conversation with them, let them know that your financial situation has changed, your needs are no longer focused on maybe prematurely passing away, but now you want to focus on and look at options to help guard against outliving your expenses, or maybe there being a long-term care event. And they should be able to help you understand and outline your options and walk you through whether or not a 1035 conversion is permissible. Know that if you have term insurance, that's not something that typically can be portable and used as a 1035, but this is really going to apply more so to permanent whole life, variable life type policies.
Another question here, do employers typically match your HSA contributions like they do with 401k? Certainly with 401k, most employers provide some sort of a match. Just in my experience, I don't have the statistics, but I can tell you that the majority of employers do not provide a match to HSA contributions. I have seen some employers who will simply offer a, they'll put a certain amount in the plan. For example, if an employee registers for the high deductible health plan, they might put $1,000 or $2,000 into your HSA account for you, usually not through a match type of thing, but just a direct contribution. But that's more the exception than the rule.
See another question here that asks about what happens to an HSA after the account owner passes away. And that's a really thoughtful question and something that folks are faced with. In the case that there is a surviving spouse, the surviving spouse can take over that HSA and use that as their own. And again, it continues to have those tax characteristics of being a qualified distribution for medical expenses. In the event that the beneficiary of that account is a non-spouse, that be a child, a grandchild, essentially they take that account over and it loses that HSA wrapper, more or less. And it's essentially money has to come out of it, and it will, much like it does with an IRA, where things are taxed at that taxpayer's prevailing ordinary income tax rate. So maybe another call to action is to check the beneficiaries on those HSAs and make sure that your spouse is primary so that they can preserve that tax characteristic at the passing of the first spouse. Thank you so much for coming to today's our presentation on healthcare. We hope to see you in August as we continue the conversation and focus more specifically on Medicare and expand on it more than Brian did today. If you're looking for more information about Savant and what we do, I invite you to join us and look us up at savantwealth.com. Thank you again and hope you have a tremendous day.